Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. So welcome, Boris. It's great to have you back on the podcast. You're one of my favorite guests I've had on the podcast show in the almost feels like 100 shows that we've had so far. So welcome back.
It's a pleasure to be back, and congratulations for the amazing job that you've done in such a short time.
Great. No, appreciate that. Now, clearly, there's a lot of uncertainty in markets right now. We had this quiet summer period, and we've come out of summer with so many different cross-currents. There's energy crisis, there's taper talk. Central banks are trying to work out whether they should respond to high inflation or not. There's a China story, and there's a lot of confusion. And you recently published some new work where you describe something called the reverse Goldilocks, and you've created this very, very sort of good presentation, the reverse Goldilocks macro regime, which I read through and I thought it was excellent. And I think in many ways you've been able to sort of draw together lots of these cross currents into a framework which we can then use to hopefully invest successfully in markets. So I thought we could start with that, and maybe you could talk about what you mean by the reverse Goldilocks, and then we can go from there.
Sure. Yes. Obviously, the kind of coming up with a concept was a bit of a work in progress. Obviously, everybody's been talking about stagflation for a while, right? But somehow we thought that stagflation probably is not the best way to describe the current situation, because it's very likely to be very different from the 70s, which is our kind of key benchmark for stagflation, or the post kind of communism collapse, where you had the big GDP drop with high inflation. That was also a stagflation as a structural crisis. But this current period is different. And obviously, coming back to 101 macro and thinking about the four regimes in which any economy would be at any time, based on the direction, second derivative of growth and inflation, as well as the level, you have four options. And we know well the boom-bust cycle. So it's strong growth, strong inflation, weak growth, weak inflation, or deflation. Yeah. But you have the other two quadrants, which are which we know obviously about Goldilocks, because in terms of 2000, 2007, and then immediately after Lehman for about 5 years, that was kind of the dominant period in which EM did great, carry trades did great. That was the big emergence of the carry trade as a concept, low volatility. And it was characterized by weaker growth by okay growth and weaker inflation, right? That was the so-called Goldilocks period. And the reason underlying that regime basically was the boost to supply, which came through very strong investment in China and the integration of China into the global economy, full and very profound and very efficient, with the transport networks and the in-time supply chains emerging. And at the same time, obviously, technology plays a very important role for the supply curve. The emergence of shale and US bringing a lot of oil, cheap oil, to the market. That allowed the supply curve basically to move towards the demand curve. And post-Lehman, the demand curve was practically soft because people had to delever, and banks also had to repair balance sheets, raise capital. So the two curves were moving to each other, and that was bringing price pressures down, allowing central banks to try to support demand and pump a lot of liquidity without any impact on inflation. And in reverse,
so the key thing there, I guess, is that all the supply side issues we've had have been positive over this period of time, whether it was the integration of China, whether it was the shale gas. I mean, it was all moving in the right direction.
Yes, absolutely. And technology as well, internet effect and so. So in the current period, I think we are in a situation where those two curves have moved away from each other. Right? And that's why the reverse Goldilocks in a way, right? And on the supply side, we have experienced constraints not only due to COVID. I mean, COVID has played an important factor, particularly on the side of labor supply. And there is a lot of work being done on the participation rate, on the fact that still in surveys people quote risk of infection as one of the reasons not to come back to work and so on. So that is one element, but I think it goes deeper, it goes further and deeper.
Okay.
Right. I think you get practically the start of that period from the point where the trade frictions between US and China started to emerge.
Okay.
And the whole idea to practically reshore and to create practically two supply chains or multiple supply chains in this context would imply certain level of disruption, at least until that transition is complete, right? That's kind of one thing. The other thing...
And that, was occurring before COVID, of course.
Yes.
And COVID kind of magnified it.
100%. Yeah. So we were already into that environment. But there is something even deeper.
Okay.
Right? And I find it fascinating, actually, how relevant it is to the energy shock that we are seeing. I mean, that reminds me, basically, what in two words is that we have not invested enough in the real world in the last 20, 30 years.
Yeah.
And it reminds me of the joke about the hospital food, where the patients are complaining, saying, this hospital food is terrible. And he says, yes, of course. And it's such small quantities, So we have been investing not in clean energy for a while.
Yeah.
And it has been in small quantities. Just to give you an example, the IA investment report shows just in power gen, we've been investing 800 billion per year since 2010.
Okay.
In that period, global GDP and global money stock has doubled.
Okay.
Relative to output and relative to money, we have halved our annual investment by 50%, even including the increase in investment in clean energy, right?
Okay.
And why is that? And you can think as implications for real interest rates and the saving glut, right? I mean, obviously, if you do not invest, you will have more savings. But at some point, you also are going to get more inflation. That's the idea, right? And the good thing about this cycle, this type of macro regime or part of the cycle is that it is not that frequent.
Okay. Yeah.
Right. If you look at the last 25 years and you define the four quadrants, boom busts, the standard boom busts are about 50-50 equally distributed. As a distribution one against the other, axis wise. Goldilocks versus reverse Goldilocks has been 80% Goldilocks, 20 reverse Goldilocks.
Okay.
Very, very small. And there is good thing about it that it's a difficult regime. It's good that we haven't had it for so long. But it also means that it will be more confusing because even from the point of view of econometrically estimated forward conditional probabilities of return for various assets, we cannot draw from the historical distribution. Because we have to go back to the 70s. In order.
And you mentioned the 70s. So are there differences between this reverse Goldilocks and the 70s?
Yes, I think that there definitely are differences. And clearly, by far, the biggest difference is technology. And the second big difference is the level of the degree of unionization, right? Unionization. So both of those would probably preclude the substantial surge of inflation to the point of the amount of money that we have created. Right? So we need not be afraid for a very high inflation surge. But can we have inflation that is 1% above the targets of the major central banks? I wouldn't say that this is unthinkable or impossible, right? And that's one difference. The other, I think, is that you do not have the concentration of the economy in terms of having fewer sectors and smaller number of products.
Okay, yeah. So the economy has got more diversified today compared to back then.
Exactly.
Yeah.
And usually the more diversified the economy is, the less possible to propagate an inflationary impulse.
Yeah.
Japan is probably the best example for that. It is the economy with the highest number of individual single products.
Is that right? I didn't know that.
So, yes, I mean, you just have to go to Japan to see.
It's true, actually. yeah.
The incredible choice you would have
that is
as
true.
consumer, right?
Yeah.
So in this context, the more products you have, the less pricing power the marginal company would have, or the marginal sector or marginal product type. Because the moment the price goes up, the consumer can never have the whole basket, so they would shift to something else.
Yeah.
And again, that kind of preserves a lid on a high inflation, but there are underlying processes which can still bring us into a reverse Goldilocks. And I don't say that we are in reverse Goldilocks now. We are the markets are always forward looking, so the markets start behaving as if we are.
Yeah.
But based on that metric, on the 4 quadrants, we are still in inflationary boom.
Okay, yeah.
Right?
Yeah. Because growth is still high.
Growth is still PMIs are well above 50. World PMI is 54, right? So that's not we're not at in a too bad place yet. Even though
and just one thing on the monetary and credit side. How do you see that? Because obviously after the global financial crisis, we saw significant regulation, and banks, even by themselves, were deleveraging. And so that sort of broke the transmission from base money increase to credit growth. In the 70s, I don't know the exact sort of numbers there, but I imagine credit growth was a bit stronger, back then, and there was less financialization, you could say. I mean, how do you kind of see that whole transmission from, QE or base money increase to credit growth?
There definitely is constraints in the financial sector, and you can see that probably crystallizing in the unwillingness of U.S. banks to add to reserves and the rise of the RRP facility, right?
Yeah.
If the banks are telling you that they do not want more reserves and do not practically want more QE, it means that they do not think that the asset reserve ratio would benefit them in terms of making money out of it, right? Now, what is different, I think, to the 70s is the rise of shadow finance, and particularly the rise of crypto. And it is fascinating that if you think of crypto as money stock, it is the 5th largest money stock in the world after China, US, Europe, and Japan. 2.5 trillion. And that is a money stock that is mostly deposits and has no lending on the other side. Right? So obviously it is a slow process, but if that DeFi, decentralized finance industry continues to develop and can create a transmission, and I'm not talking about internal leverage for speculation, right? That is happening already. And there have been a few burns there, but I'm talking about transmission to real activity, either on the consumer or the investment side. That would definitely have impact on the multiplier in real terms, right? So it will move the aggregate demand curve to the right. It will strengthen the aggregate demand, right? And obviously this is probably still early days, but when we are thinking down into this decade, into the business cycle, having delevered consumer, partially delevered corporates, or at least big corporates were big winners in this process, and that catalyst, you can envisage stronger stronger money transmission into the next 10 years as compared to the pre-Lehman period. Right? And there is another element to credit demand, totally different from that, and it is related to decarbonization and to greening that insufficient and dirty energy producing stuff. As the IMF is projecting, we need between 6 and 10 trillion annual investment for the next 10 years. So about $1 trillion, 600 billion to $1 trillion per year globally. That's about 1 percentage point extra aggregate demand per year, which isn't small for the world altogether. And I would assume that a decent amount of that will involve some form of public involvement, either through tax policy or actual projects.
Okay, that makes sense. So basically what you see there is sort of public-backed investment in the green sector that could underwrite credit in some form or another, depending on public-private partnerships or just some form, like that. You're seeing a lot of talk about that in Europe and Germany and so on. So that's probably kind of the leader in this space. Just a couple of things just to follow up what you were saying there. I mean, were you surprised? Are you surprised by the unwillingness of US banks to lend to the real economy over the past 12 months? You know, that they kind of just seem to be wanting to sort of move all the cash away from themselves or the reserves away from themselves and just not want to sort of lend on.
First, I wouldn't say that US banks have not lent to the US economy. And here, obviously, I'm not speaking as a Goldman Sachs employee. No. This whole discussion is as a private views and my personal opinions. Yeah. But if you have to differentiate on the numbers, even if C&I loans have not gone up, securities held by US banks are up 18% year on year. Yeah. So the lending has gone through the securitized channel, right? Yeah. And there has been some transmission. I think,
but is that mainly to treasuries? Is it mainly to the government?
No. I would say corporate, non-government securities. Non-government securities. Yeah. Okay. So I'm talking about corporate securities.
Okay.
So it is a different form of transmission. Yeah. On top of that, in this early part of the cycle, following such a large fiscal transfer to the private sector has enough cash because of the fiscal injection. So operational cash balances are okay, and lending, actually the credit demand, paradoxically, so early in the cycle is not there. Yeah. The credit demand will come later after the commodity price shock and with a higher price level, when companies start building up more and more inventories and the whole private side of the economy starts roaring, so to say, right? And I have no doubt that over the next 3-4 years, this will be the direction of travel of the US economy, even though everybody's a bit more concerned about next year, right?
No, absolutely. So that makes sense. So actually the credit growth side in terms of lending to the private sector is telling us more about the household balance sheet, which has been so strong because of the fiscal transfers rather than a supply issue per se. Kind of a related point, I suppose, and this is something, I've often been thinking about when I speak to investors as well, is can we classify the downturn that we saw last year during the peak COVID, where economies collapsed around the world? Is that like a proper recession? And so we're at the beginning of a new expansion, or are we in the same expansion as the post-GFC period? And that was kind of like a mini correction of sorts. And so we're late cycle right now. I mean, because last year wasn't really a proper recession in many ways. If you just looked at household income, credit, all of these sorts of things.
That's a great question because it touches on the definition of recession. By NBR terms, actually, 2 quarters to success. You have to probably avoid the concept of recession, and then you can make the argument about late cycle. Now, where I do not agree with the late cycle definition is, we first on the recession concept, the depth of the shock was so intense and the magnitude that irrespective whether you call it recession or not, this is one of the biggest shocks that we have seen with the biggest follow-up rebound that we have seen and the biggest fiscal response post-war, right? Yeah. Highest public debt levels. So it has created macro volatility in the system. Yeah. That will probably be double the average recession macro volatility that's generated, right? So from the point of view of asset prices and investment, that macro volatility might be a lot more relevant of whether we would label two consecutive quarters of negative growth.
Okay,
and so on. Yeah. So what definitely is not stagnation, right?
Yeah.
In that. So the whole concept of secular stagnation now is part of a previous period, right? So we are definitely moving away from that. Now, in terms of whether we are late cycle, I think one of the characteristics of late cycle is highly indebted private sector or any sector that needs to delever. Now, if you look at the balance sheet increases, the biggest balance sheet increase post-COVID is the public debt balance sheet.
Yeah.
The public debt balance sheet, however, apart from situations in emerging markets where it becomes unsustainable, is not a great cyclical driver per se, because in the real world of the big macro blocks, the public debt is the safe asset still, right? So that's why I tend to believe, and people are saying, commodity price increases, this is late cycle phenomenon. There is an element to that, in a way that in a late cycle, you have a buildup in financial balance sheet that triggers excess demand, that triggers that energy price spike, and that energy price spike can shortcut demand T+1 and trigger a deleveraging. Now, the thing is that the current energy shock is unlikely to trigger a deleveraging snowball. Apart from maybe in sectors in China, and then we can talk about China maybe. If you think it's
we should definitely talk about China, but actually you mentioned that public debt problems don't apply to many DM markets, but it does to some EM markets. And I just wanted to pick you up on that point, which is why is it an issue for some EMs? Is it the fact that they don't have the right institutions or credible institutions? Is it the fact that there's a currency issue? Is it that they have foreign holders of their debt? I mean, what is it about EM that prevents them from running large, public debt to GDP ratios?
This is the standard EM/DM 101 kind of differentiation, and it is all about the saving rate and the trust in the national currency and in the national safe asset, right? And it's not so much. I mean, often people say it's foreign speculation that causes those crises. The real essence of a typical EM confidence crisis or debt crisis is that at some point the country, the national savers, they decide that they don't want to keep their savings in the national asset, and they start heading for the dollar, right? That's what happened basically in Germany after the First World War. Right? It's not a typical emerging market phenomenon. It's the phenomenon of confidence loss. And the ultimate epitome of example of the other side is Japan, where practically after decades of public stimulus and high private saving, private assets and public debt have been going together. But because the home bias and the confidence in the system is so strong, Japan is the most monetized or over-monetized economy with the highest public debt level, which remains completely sustainable because the social contract works in that context, right? EM, of course, is differentiating, and there are countries where you have reasonably high domestic saving, and also partially because of capital controls, the money remains there, and it's not going to head to the door anytime soon. And maybe China is part of that, important part of that group because of its size. You have other countries like Brazil, where the rise in public debt to GDP has been more concerning for domestic investors, and that has led to capital outflows. So I think that that is kind of differentiating factor. The biggest paradox in that kind of typology is Russia, where you practically have a sovereign that has zero net debt. There are only 4 countries in the world that have no public debt. And at the same time, the domestic investors, they have almost insatiable demand for dollar assets or for foreign assets, right? So
Now you talk about China, and obviously there's a lot of focus on China at the moment, the real estate sector, Evergrande, and so on. And there's also energy issues, factories shutting down. I mean, how do you contextualize this? Is it are you worried about China or not?
It is very interesting. I think China is obviously a huge economy and very very diverse structure among the provinces as well. And I think generally when we try to make a rational judgment about what's going on in China, we have to be really careful how we build our knowledge first, right? Because what is happening is clearly the domestic news sources, they'll be uniformly positive most of the time, and at the same time, what's happening on the external information sources, you would have an increasing bias towards negativity. First, because negativity sells better. I mean, this is 101 media business, but also because obviously there are some problems happening. And we have a clear situation recently with the private property developers, right? And I think that I prefer to actually rely on the numbers which are hard numbers.
Okay.
And I definitely look at the PBOC balance sheet and what's going on there. And when I look at that, and we've been saying that for the last several years, is that PBOC is doing quantitative tightening, which is a risky policy. It helps to stabilize the currency or to make it stronger, but is at the cost of increasing the credit risk in the system. Why? Because when you have economy that's growing at 10% nominal per year, and you reduce the money base by 17% over 3 years, you are going to massively increase the velocity, the required velocity in the system. And through the money market channel, that will start squeezing the most levered borrowers. Now, when we think about China, I think it's very relevant to think in terms of the big guidelines which the government has given as policy directives, because clearly an important characteristic of the Chinese economy and system is that it is planned. It is based on direction of policy targets that need to be fulfilled over a certain period of time. And these targets go from very broad kind of lines into they structure and crystallize into directives per sectors. So the big three that we need to know is that they want to reduce income inequality. That's number one. Number two is they want cleaner environment. And number three is they want to reduce financial leverage. Right? So in this context, the difficult situation which some of the property developers have gotten into is because of 1 and 3. And that means that, given that these policies are part of the big directive, it is less likely that there will be immediate relief on that. Now, where I hope that there will be a relief and there will be change is in the policy of quantitative tightening from the central bank. And if the central bank pulls back a bit on that, and I don't say that they should start doing a large QE and flood the whole system with huge unnecessary amounts of liquidity, but just to bring back at least and give back these 17% in the money base in the course of the next 6 to 12 months, that will relieve or will prevent that process of deleveraging from going from property developers to other segments, which will have then bigger impact on employment and output, which would be unwelcome, obviously, given that they have employment as target, right? So in that context, if we get soon, I would say sometime in October, steps from the central bank, and there I'm not really thinking about interest rate cuts, but I'm thinking more about the quantitative policies. And they would be safe because, you would be so tight if you are close to run a current account deficit or trade deficit. But given the amount of export revenues that they have accumulated over the past 1 year, the risk is not that dollar China is going to go higher. The risk is that there is $1 trillion of deposits. And at some point, if you get that short liquidity, corporates will have to start selling them and the currency can strengthen, right? So it's a different situation from the typical EM risk situation. And another number which I think is very relevant, energy consumption. The power shortage in China is not just because of coal production reduction, because what you have is 13% growth in rail transport. Half of rail transport is coal, basically, to the power factory. 22% increase in services energy demand.
Okay.
This is not an economy that's on the brink of recession. Right? That's January to August. These are recent numbers. So clearly property is important, and it's an important part. But property, I think you have to think of it as part of the asset management of the Chinese household. It is a saving instrument,
Yeah.
right? That creates real world investment. But because Chinese will not continue to save less, or not, they will probably move some of their savings into the equity market. So the current difficult situation on the property side might lead surprisingly into an equity market rally next year. And if you look at the past 5 property busts, after 2 of them, there was a very big rally in equities.
Yeah. Just on the point about quantitative tightening, I mean, despite the quantitative tightening, we've still seen relatively strong growth in credit over this period, over the last 3-4 years. So that, the debt to GDP, or the credit, however you slice and dice the credit numbers, it's been quite strong over that period of time. So, I mean, how do you square that circle?
Yes. Okay. First, you do have China is still well below 100% on loan deposit ratio, right? So they have relatively large deposit base. But what I mean is that in the system, the money market, we are coming back to Lombard Street. The money market is the high velocity part of the core that would redistribute between the haves and have-nots in terms of meeting the requirements to balance the books, right? And if you let it's like an inverse pyramid. If you let the top end of the pyramid expand at a fast pace, but you keep the core smaller, or unchanged or smaller, you will, by definition, increase the velocity in the intermediate sector. So a key indication of such situation would be stress in the money market and money market rates starting to kind of push higher, right? That's kind of one of the indications. I think that has not been the case yet. Apart from short periods, there was actually some pressure up in the weeks before, and PBOC reacted immediately, adding 450 billion of liquidity just before the Golden Week, right? But it could develop if that type of credit stress broadens beyond the external developers. That's my point. So I think if I would be a policymaker, I would think about the contingent risks rather than the immediate state of the system. Because these decisions are all forward-looking. And speaking about policymaker, maybe we can talk briefly about what's the optimal policy in reverse Goldilocks.
I was going to ask you that. So what is it?
It is very interesting, I think. I mean, this is pure speculation, of course. I don't think there is a textbook written on that. But if you think about it, during the Goldilocks period, obviously optimal policy was maximum support from monetary, and probably would have been more support from fiscal, but we didn't get it, right? So that was the kind of the main argument of the secular stagnation theme. So in reverse Goldilocks, clearly you would need better coordination between monetary and fiscal, and from investor point of view, it will need more attention on monetary and on fiscal, but in a different way, right? So it is obviously fairly difficult to predict, understand the fiscal impact, right? Because it is complex. There are political uncertainties as we follow daily what's going on
with the debt ceiling and so on.
With the debt ceiling and with the package, social and infrastructure package. So in that context, I think let's speak briefly first about monetary. I think that one key differentiation from Goldilocks is that hawkish monetary policy is not necessarily bad for risk. And let me explain that, because it sounds very counterintuitive, right? But in reverse Goldilocks, you have 2 scares. You have the inflation scare and you have the growth scare. And the market, the investors, they linger between the two. They would go from one to the other. It can be in one region or another region. So this year, for example, is the year of the US inflation scare and the China growth scare. Right? So as a policymaker, you have to be sensitive to where the scare is, right? That's kind of the key thing. And then basically, if you do address the inflation scare, you address it one way. You take a more hawkish stance, right? And this is what the Fed did. What you do is, that's not bad necessarily for risk, because what you do is you basically clip the inflation fear part of the distribution.
Yeah.
You stabilize that. You're moving to clip it. You're reducing uncertainty about your policy. That's already a positive, right?
Yeah.
And then also you're opening your space to move towards easing because you have created a hawkish move, right?
Yeah.
So that is kind of your condition. Of course, you have to be very sensitive.
Yeah.
If the pendulum swings to growth risks, that you do not stay on clipping inflation risks for too long. So dynamic policy decision making
and in that context, does it matter whether you focus on QE or tapering versus policy rate hikes? I mean, is there a distinction between the two, or is it broadly the same direction? It's hawkish in either case, so it doesn't matter.
It's a great question, and I would say by all means, rate hikes have more significant implication. And there is a very interesting loop process there, which I hope we are not going to see, right? But that is the loop of the debt sustainability. Right? Because public debt sustainability, because you have to think about as the inflation and growth risks as these two doors in the action movies, like Indiana Jones, that may start moving close to each other. As policymaker, you do not want them to move too close to you, because if they close, then becomes impossible to stabilize and to do anything with monetary policy. In that situation, any easing destabilizes or increases the risk premium on public debt. Because you are in a kind of proper stagflation scare, right? In debt sustainability scare, and because any addressing of growth then increases your inflation risk and destabilizes, and any increase in inflation, any clipping of inflation risk deteriorates your growth expectation. So at the moment we are definitely not there. Right. This, I see a very small probability that we enter in such situation. We are not there in terms of public debt to GDP levels and so on. I speak about developed world, right? But these type of developments have happened in the past in emerging markets.
I guess so. Right?
And the only solution there is a debt default and resetting the system. Right. This is your Argentina or early 2000s in a number of EMs. So, of course, in the end, people say this can never happen. But I say after COVID, the probability obviously previously probably has been 1%. Now it's probably 5% over the next 10 years, right? So it's non-zero. It's not negligible. And as a policymaker, you have to be very sensitive on the two sides of the risks and be more active in addressing those, right? That's on the monetary. On the fiscal, I think is also very relevant and very important. Almost as important as the monetary, because you have practically three choices, I think. Tighten fiscal, and regain fiscal space, and stabilize the debt to GDP level at the cost of increasing the growth fears. Now the fiscal has also must be sensitive whether you are into the inflation scare or the growth scare, right? Because if you tighten the fiscal when you're in the growth scare, you'll be accelerating that effect. The second thing is, and I think it's very important to filter all new information in terms of macro and decisions to this supply demand curves. Are you moving the demand curve with your fiscal decision, or are you trying to move the supply curve? This is probably the most important. So, for example, and in that context, I'll come back to QE. So the absolutely optimal policy would be to maintain QE and fund energy infrastructure investment. Why is that? Because you will not be crowding out the private sector. The private sector will be able to also invest more, which will give you more supply. That, by definition, should be reducing the inflation fears and reducing the growth fears at the same time. So my optimal policy, actually ECB and Europe in particular, is pretty close to that type of framework, right? With the Green Investment Initiative, the Recovery Fund Initiative, and the idea that after PEPIs is reduced, there should be probably a bump up in the running QE rate. So that's kind of how I think the interaction is. Obviously, if you do fiscal for subsidies, given the energy shock, you will be anchoring the inflation side at a higher level.
I understand. So that's quite a compelling case for the fiscal side. Now, in terms of the implications on the macro side, I mean, what does this all mean in terms of growth, prices, and so on?
I generally think that we will see slower growth over the next 12 months, but I do not think that we are going to see a double dip recession. And I think that China will stabilize and will start improving into next year. European growth will moderate and US growth will moderate with the fiscal cliff. But I would say I do not think that the relative price shock at the moment is at a level that is going to completely destroy demand, right? Okay. Also because the private savings are significant coming out from the COVID shock, and the sovereign is less sensitive to the energy price shock. Right? And in this context, I think the most important relevant macro factor for investors to think about is terms of trade, or input-output prices, or in good old words, who is benefiting and who is losing from this relative price volatility, right? So that's kind of the thinking. And terms of trade is very interesting because it allows almost, on a daily basis to classify and to see what's going on. So it gives you a high frequency update of where the countries are heading to, or companies. And you have to, of course, contextualize that on the basis of the saving rate of the country or the cash levels of a corporate, depending on what you're looking at, right? So the shock absorber potential. So you have in one segment countries that have high savings rate and positive terms of trade shock. Those countries, they can be in their own Goldilocks environment within the reverse Goldilocks of the world. Why? Because they can let their currencies appreciate somewhat. They'll get lower inflation. And they can invest more, import more technology, and grow faster than they would in a normal situation, right? And
what are some examples of those countries?
I mean, these would be your energy exporters that run current account surpluses. This will be your Middle East. It will be your Russia, Kazakhstan, Indonesia, Malaysia in Asia, right? So these are Colombia is not running a current account surplus, right? But it definitely is a big beneficiary of that. And you do have, of course, countries that traditionally have lower savings rate and they have positive terms of trade shock. The effects there will be positive, still positive, but it will be trickier. It will not be as straightforward. Like the political risk will be more important. This is your Brazil, right? That's So if we get the direction of travel in politics that kind of brings back investor confidence, actually Brazil can experience a very positive period in this situation. And then you have countries that unfortunately have basically they're losers in that environment. They are big energy importers. They will have to maintain higher real rates in order to keep the especially if they have low saving rate and run current account deficits, right?
Which then is obviously more challenging for the policymakers in those countries because they have to face the trade-offs there.
They'll be facing the trade-offs, and it will be more risky if they decide to start easing policy, for example, especially if US is stabilizing inflation, right? That is kind of, you have to then contextualize yourself on what US is doing as EM policymaker. And that is going to be more challenging. Of course, now most of the emerging markets actually are normalizing and tightening. And they will probably be able to stabilize inflation more successfully and faster. So as a whole, probably the inflation differential between EM and DM is going to be the narrowest that it has been for a while, which is not necessarily bad for emerging market asset class as a whole.
And what are some examples of the countries that have this facing negative terms of trade shocks and have poor savings?
I mean, look, actually, luckily in EM, all North Asians who have negative terms of trade shock, they actually do have relatively high savings, right? And they have high beta to global trade, which has been doing very well. So they're not immediately impacted. I mean, this is your India, your Korea, China. They rank up. In this time zone, clearly Turkey stands out as risky. Of course, they're benefiting from some improvement with tourism now that they have done very well on their vaccination rate, that improvement on the service side, tourism in particular, is going to buy them some time. The strength in Europe is buying them some time. But if Europe starts slowing down, and with energy prices where they are, over the next 6 months, 6 to 12 months, it will become more challenging to cover a widening trade deficit.
Okay, understood. And if we just round things off, I mean, what are the broader implications for global real rates and the dollar?
Yes, I think obviously this is the $1 million question. For the dollar, it's not that straightforward because I think we're swinging between these fears from inflation to growth creates a very choppy 2-3 months kind of moves in the dollar. And I think that will continue. So if we swing now to growth fears to yes, the dollar will probably weaken, most likely weaken, right? And I think for investors, it will be more interesting to think more in terms of the terms of trade axis across currencies. So in this context, funding in yen, for example, might be more interesting because also term premium might have to rise given all the investment that we might need to do in energy infrastructure and so on. So that's kind of another theme. Volatility, also long-term volatility, will probably have to increase if the macro volatility of growth and inflation is higher in this cycle. And then correlations, especially if we enter into a reverse Goldilocks regime, correlations between assets will be very different from the standard. So that's another theme that investors have. And we see it already this year, where actually being long treasuries has not been a good risk-off hedge.
Yeah, correct.
And that's why people tend to overweight buying dollars as risk-off hedge. But as all hedges, that's also not without its risks. Right.
Yeah, no, that's really good. I mean, there's some really good takeaways from our conversation. I mean, one important one is that we need to use a different framework in the environment we're in today. It's the reverse Goldilocks framework rather than the secular stagnation framework or the kind of the golden era 1990s framework. And then the other one is the importance of understanding terms of trade shocks, which I guess we haven't really thought about that much, beyond smaller currencies when we've had big rise in oil prices, but this becomes a lot more sort of central now. So it's really your useful framework, and it's a great sort of insights that you provided.
It's been pleasure to be able to discuss and debate.
Yeah,
and of course, in future, any feedback, thoughts would be greatly appreciated from your side, as always.
Yeah, absolutely. Yeah, and if listeners have any feedback, viewers have any feedback, then sort of pass it on to me. Then I'll pass it back to you, Boris, and we can kind of keep this conversation going. So
because it's an evolving environment, right? And,
absolutely. Yeah. I
hope we do not enter into that regime properly.
Correct. Yeah. So thank you very much. Great. Thanks.